So Agar would be very similar to the flexicap fund.
Okay.
That's where my equity investments are. Today, the mid plus small cap exposure in flexicap would be in single digits. So 5 years back, fixed income was very limited.
Okay.
Fixed income allocation has gone up. So it used to be 4, 5, 6% kind of range. That has gone up to now 12 odd percent, 12, 13%.
Okay.
So gold has largely been in the form of jewelry. So one is the normal contingency fund or normal emergency corpus, which would be roughly 2 years of expenses kind of thing. So one bias that people can get rid of is recency bias. A lot of the investing decisions get determined based on today's newspaper headline. Spending too much to impress people really doesn't go a long way.
Welcome to the latest episode of Guru Portfolios, where we quiz fund managers, ace investors, and leaders from the world of finance. In today's episode, we have with us someone who believes in the idea of equanimity amid the chaos and noise of the markets. We have with us Rajeev Thakkar, who is the CIO of Parag Parekh Mutual Fund, which manages assets over rupees 1 trillion. Hi, Rajeev. Welcome to the latest episode of Guru Portfolios. It's great to have you here.
Thank you.
How your portfolio and your personal investing has been, say, over the past 5 years, and also over the past year, how has it evolved?
So, last 1 or 2 years, we have been cautious as a fund house in terms of given where the valuations are. And that is reflected in my individual investing as well. So, most of my money in the last 1.5 odd years, 2 years, has been in hybrids and in arbitrage kind of
Okay.
funds.
Okay.
So, given that the valuations are elevated, maybe stocks could deliver slightly better than bonds. But given that my skew has been so much towards equity,
Yeah.
and given that I am now in my 50s,
Yeah.
I'm starting to allocate some money towards
Okay.
arbitrage and hybrids.
Got it.
And the other thing is that I'm on the off ramp as far as my term insurance goes. So I never took the investment related insurance products. A very small one was at the very beginning, but otherwise, largely insurance was term insurance. So, given that savings have built up, now there's no need incrementally for term insurance. So, that is on the off ramp, and even health insurance, I have slightly lower cover as compared to what typically there would be
Sure.
coverage. So, given that scenario, I'm also building a emergency corpus for health
Okay.
or other needs.
Sure.
So, allocation has been towards
Okay.
hybrids and
Okay.
arbitrage.
Sure. So this contingency fund or emergency fund, how many, like if you have to quantify it, how many months or years of living expenses how do we, can we put some quantification to it?
Sure. So, one is the normal contingency fund or normal emergency corpus, which would be roughly 2 years of expenses kind of thing. But the health related contingency fund is, let's say, if I have a target insurance amount in mind, then I would want to have, let's say, 10x of that amount as a corpus.
Fair enough. Okay.
So that the returns over a period of time take care of medical
Got it.
exigencies and things like that.
That also you want to, and that corpus, how you're building through which funds or which asset classes?
Hybrids, debt oriented hybrids and arbitrage.
Okay, got it. And this new money that you mentioned earlier that you are now putting in hybrids and arbitrage, but within hybrids, it's again in conservative hybrids.
So dynamic asset allocation
that-
fund, which has the long-term capital gains tax benefit.
Sure.
That is a place where I'm
Okay.
working, and the
Got it. Fair enough. And how do you see that it has, if we have to kind of split it between equity, debt, uh, gold also to some extent, if you can give some split on that, how is that?
So gold has largely been in the form of jewelry.
Right.
I haven't had a explicit exposure to gold, but for ceremonial reasons, on auspicious days, some buying happens,
Okay.
some gifting happens. So there is gold, but not in the form of bars, etc. Uh, Fixed income allocation has gone up. So it used to be 4, 5, 6% kind of range. That has gone up to now 12 odd percent, 12, 13%. And if you include the contingencies and retirement funds, then it would be closer to 20 if you include everything. So allocation towards hybrids and debt has gone up.
And the remaining is your equities.
Yes.
So now, and over the past 5 years, like if you can give some rough numbers, 5 years back, how it would have looked like, and just for some color on it.
Sure. So 5 years back, fixed income was very, very limited. So 5 years back, incidentally, was the COVID low. We are in 2025.
Right.
5 years back was March, April, May 2020.
Yes.
And valuations were super exciting at that time.
Right.
So at that time, even some lead allocation tactically had moved to equities.
Okay.
So 5 years back, equity was very heavy. Fixed income was very, very low.
Right.
Today, that has changed.
What would be equity? Would it be like exceeding
95%.
95? And how has your portfolio done, say, over past year and over past 5 year also, CAGR?
So CAGR would be very similar to the flexicap fund. That's where my equity investments are. So I think last 1 year has been, as per the last fact sheet, 13.5% or thereabouts. 5 year numbers, I can share them, of course, 28.5 or somewhere thereabouts. But it's not representative. There's a big element of base effect because 5 year back was the COVID low.
And within your equity pie, it's, I believe, largely through the flexicap fund.
That's correct.
So, but how, maybe for our viewers and listeners who are listening you for the first time, how is the split across large, mid and small?
Publicly, we've been stating, as a fund manager, I've been stating that the general valuations in the small and mid cap space have been more elevated than the larger cap company. Today, the mid plus small cap exposure in flexi cap would be in single digits. So bulk of the money would be in large cap.
And also, Rajeev, you have a decent, exposure to the unlisted shares of your own company, which you have bought over the years, ESOPs, etc. And of course, you had an opportunity to increase it. But going forward, you think this share will remain as it is, or you may, if you get an opportunity, you'll look to. And just for clarity, this is unlisted pie, and it's got nothing to do with your retirement corpus and anything of that.
So this is not a listed entity. There's very poor liquidity in this. So mentally, I've just carved that out and not taking financial decisions based on that stake. It's more like a business asset or a family asset. So just like primary residence will have some coded value, but you are residing in that or whatever. So it's not really a financial asset in that sense. So here, as of now, there are no plans for the organization. At least next 3, 4 years, I do not think there is any plan to list, and it's a hypothetical question. We'll see as and when something happens.
Fair. But whatever previous discussions we have had of your asset,
That remains. That asset remains in the portfolio.
But when we spoke about the equity, debt, and all of that split, did you include that in the unlisted part in this discussion? Or
So I think last time we spoke, we had mentioned something, but it doesn't give an accurate picture in terms of the weightages, etc. So for the purpose of equity versus debt versus gold, I'm including only the listed and the mutual fund space. And this, given that it's unlisted, it's not part of the calculation.
Thanks for that. And also, on your retirement corpus, retirement goals, have you already reached that target? You already obviously explained that now you're shifting some, new money at least to hybrids and arbitrage. So have you already, reached those goals, and or do you think you need more, or do you now want to enhance that corpus since you're in the last years of your working life, quote unquote working life? I know you have plans to. work. Yeah.
As long as I am in good health and I enjoy working,
Yeah.
I'll continue to work rather than having a fixed date for retirement.
Sure.
Monetarily, I think savings are adequate to see me through in retirement. So, I think corpus has been reached. Now, if you keep on upgrading lifestyle, then no amount of money
Right.
will be sufficient. So, if suddenly I take fancy for private jets, then obviously money is not sufficient. But otherwise, given my regular lifestyle, the goals are largely met.
Like on retirement, because we speak with other, executives and, in guru portfolios. So a lot of people also, share their concerns, because now people are living much longer. Inflation, and everybody has a different inflation right now. Inflation, while CPI is 6%, but the consumption basket, that's very food heavy. A consumption basket may have other inflation, which will maybe at a higher rate. So, this is again, if you can share some advice for our viewers, how should they mentally think about building a retirement target and how should they go about it?
Sure. So, I think most people say that a 3 to 4% kind of consumption rate in retirement, especially if it's after, let's say, 60s,
Right.
uh, should be sufficient to meet inflation and at the same time reduce the risk of running out of money.
You mean withdrawal rate?
The withdrawal rate
Right.
in retirement. I think a 3% rate should by and large be doable now. Obviously, we are not talking about the Weimar Germany or Zimbabwe kind of inflation rates or those kind of situations.
Right.
One protection against such extreme events is have some cross country or geographical diversification. So that is one thing people could look at. Of course, Indians have this fancy for gold, which effectively protects value in hard currency. So that to some extent protects against inflation. But I think endlessly worrying about things out of control also does not help. So today, when we are speaking, last week was a time of anxiety because of the tensions with our neighbor. Now, macro event risk, there is only a limited amount of protection that you can have against those. So, I would not advise people to endlessly worry.
Sure.
Do what is in their circle of influence and not worry too much outside of that.
No, that's a good point. And Rajiv, how is your international allocation? Since you mentioned about that, part of your overall portfolio, how much would it be in international equity?
So since my money is in flexicap, around 10% of that is in international stocks.
Right.
That has been coming down over the years given the RBI limit for mutual funds.
Sure.
So recently our organization has set up a subsidiary in the Gift City,
Okay.
which will offer both inbound funds, which foreigners looking to invest in India, as well as outbound. So for Indian residents to invest in global stocks.
Okay.
So hopefully I'll be able to avail of that opportunity and invest some additional money international.
Got it. Fair. And also, there was publicly, like you mentioned, that valuations have been elevated, over recent past, and therefore, a FlexiCap fund had higher cash. So, is that stand still there, or are you gradually now looking to deploy? Because it kind of reflects your portfolio and your thinking, so that that would help our viewers also to understand.
Sure. So we have just disclosed our April fact sheet and cash is still at elevated levels. We continuously look to deploy money, but opportunities have been tough to come by.
Sure. And obviously we have been seeing this tariff uncertainty, and because of that, markets have been in a tizzy, and both in India and across the globe, right? So how do you see that situation evolve for India, and how do you also, are you picking up some thematic ideas because of these changes? Can you share some thoughts on that?
When we buy into a company, we are partnering with the promoters and managers of that business, and future is uncertain. So after we buy the stock, someone could impose tariffs, someone could reduce tariffs.
Right.
There could be geopolitical tensions, interest rates could go up, could come down, there could be recessions. So investment thesis, headwinds and tailwinds do come into picture, but they are only there at the margin.
Sure.
The primary starting point is that is this business resilient or not?
Right.
So let us say if we talk about computer operating systems,
Right.
tariff or no tariff, there are largely 1, 2, or 3 operating systems in the world, and
Right.
their business is dominant.
Yeah.
If we talk about, let's say, mobile telephones, then there are 2 operating systems largely. If we talk about banking sector in India, then there are 5 maybe large banks with a good track record, with the entire product range, with the adequate brand, branch network, everything. So we try to look at the resilience of the business. All these uh, things like tariff or no tariff and interest rates, geopolitical tensions, all these are transient factors. We don't place too much emphasis on that.
Got it. Got it. And also, what worked for you in your portfolio over the past year? Because you guys have had about 13.5, 14% returns, which is also what your portfolio has got you. What worked in the sense? Were there any themes, or was it just being large cap bias that helped?
I think on the bottom up basis,
Yeah.
not being exposed to very, very frothy spaces,
Okay.
that helped.
Okay.
And the cash helped in the downturn,
Okay.
both these factors.
And Rajiv, you have always, you have often spoken about uh, behavioral biases, behavioral finance. Can you, highlight some common behavioral biases that investors should be aware of uh, when, building their investment portfolio?
So one bias that people can get rid of is recency bias. A lot of the investing decisions get determined based on today's newspaper headlines or today's TV headlines. Uh, and as I said, a lot of these are transient in nature. They don't have too much of long lasting impact. For example, a month back, the headlines were 145% tariff on China. And a lot of people said, oh, all this business is coming to India. And if that was the single point reason to make an investment, does that decision change now with yesterday's announcement that US and China have come to some agreement and tariffs will be maybe 35%? One is to guard against recency bias, that is helps a lot. The second thing to guard against is this sunk cost fallacy or the loss aversion. If people have bought something at 100 and that price has fallen to 90, even though facts are obvious now that 100 was a wrong price to buy at and probably 90 is also not the true worth, maybe it's going to 50. People have this hesitation of recognizing a mistake and exiting it at 90. They will continue to hold it for it to bounce back to 100.
Right.
So that is again something which people should avoid.
Is it similar to anchoring because you are anchored to that price of rupees 100?
It's similar to anchoring. Anchoring typically works at the time of booking profits. So
Okay.
if you have bought at 100,
Yeah.
price goes to 200
Right.
and then falls to 175,
Yeah.
you don't want to sell at 175.
Right.
You are anchored to
Right.
200, or sometimes anchoring can be with two completely unrelated numbers. So that's a subject in itself.
Okay. Got it. Got it. No, it's quite fascinating because markets do what they do, and people behave the way they behave. So great. Uh, and also, did mention about you did mention about themes and how you look at it, but we also look at your portfolio as we are. I think all the listeners are curious how you think and invest. Can you tell us a bit more about what themes you're looking at? There is obviously renewable energy. We are seeing now that being the next big thing. Then there are these traditional businesses on the energy side, but also, like I mentioned, renewable energy, EVs. Can you take us through that? What kind of big mega trends you are seeing going forward?
So mega trends are the easiest to spot. You don't require any special insight whatsoever. Just opening the newspaper or switching on the TV channel or getting onto YouTube, you will be able to identify the big trends that are happening currently. The difficulty comes in making money out of those mega trends. Like in the 90s, cell phones were mega trends. You can walk with your phone throughout the city, throughout the country, throughout the world, and still make and receive calls, send and receive text messages, access the internet.
Right.
It was a mega trend, but most people who invested in telecom lost money.
Right.
So Bharti Airtel is the only surviving company now.
Right.
Or in India, private sector airlines were a mega trend
Right.
in the 90s.
Right.
So with mega trends, you need limited competition, you need pricing power, you need good execution by the managers. So we end up missing a lot of mega trends in our investment portfolios because that conviction does not come in many cases that pricing power will be there, balance sheet quality will be there,
Execution.
execution will be there. So a mega trend right now is food delivery and quick grocery, for example. Now you don't need to be a someone with 170 IQ to figure that out. It's obvious and in the face for everyone. One of the trends that we identified in maybe 2020 was the capital market related trends. So we were investors in depositories, exchanges, AMCs, stockbrokers, wealth advisors. So that worked out because we could identify a few companies where we thought the business economics made sense.
Right.
But in many cases, we just watched the trend unfold without really participating.
Right, because that conviction doesn't just come because it's a mega trend. It has to
Yeah,
fit
like
your.
a lot of people just keep reporting cash burn and losses. Now,
Right.
if someone has the conviction saying this will stop at
Yeah.
point X and then
Correct.
positive cash flow will be there and
Sure.
the consolidation will happen, then one could arguably earn a lot of money, but
Right.
that becomes very, very risky in that case.
And also, if you can, give some advice for young investors, how should they go about investing, or just maybe starting out, or maybe have their first salary in their hand. How should they go about investing?
I don't want to be too much of a spoiled sport, but
Yeah.
spending too much to impress people really doesn't go a long way. So I'm not saying live in poverty to die rich. That is again not the objective. But indulgences early in life have a big cost when you consider compounding and all. So improving the savings rate a bit in the initial years and being equity heavy, I think these two things will go a long way in creating a big wealth effect.
And Rajiv, in your own, system over the years, how much you have been able to save? Can you give some savings rate for yourself? Like how much you? Well, I know you are very conservative, so.
So this is individual to individual. So my savings rate may not necessarily apply to someone else. So I have difficulty in spending money. So a lot of money gets saved. Again, personally, there's a small goal of contributing something to the society and try and make a difference to at least a few lives and things like that. So different people have different goals, but in the initial years, at least 20-25% savings should be
Right.
a minimum target for most people.
Right. No, that's because initially maybe your income is not that much, so you can, and then gradually you can increase your rate of savings, right?
Yeah, and you can calibrate it along the way. So if people figure out that uh, they are well on track to meet their goals, then maybe they can uh, step back on the saving rate and
Yeah. Sure.
have some pleasures in life that they have denied themselves, maybe some travel or some second home or a car, whatever takes their fancy. They can calibrate it along the way.
Sure. And Rajiv, like how are your like finances? Uh, how much of it, your decisions that you take are, like, is it like a family decision in terms of investments, or you make sure that you take the decision, of course, because you have that experience, and then you make sure that they are aware of where the investments are, and how does the family discuss the investment bit?
In our family, myself, my wife, and a daughter who's now 21 years of age. So three of us are there. My wife has been in the financial field, so she's well aware of how things work and where all investments are and things like that. And my daughter also is well aware of how the investment works. Although she's in engineering, she's doing a computer science, but she's aware of how investing works, how compounding works,
Okay.
need to avoid consumer debt, need for regular savings. All those things she's well aware of.
Okay. And she does her own investing? Does she have
In a small way, yes.
Okay. And any closing thoughts you would have, since we have been doing this for quite some time, how do you see what investors should, majorly take away when, when they listen to you and, especially I'm talking from, financial planning perspective, what should be some key points that you like to part with?
When you come to any office of PPFAS, at the entrance you'll see this equanimity, not genius, will lead to riches. So I think one thing people should keep in mind is that this too shall pass. Whether the time is good or the time is difficult, uh, things eventually mean revert. So keeping control of emotions in terms of not doing the wrong things will be the key to success down the road. So a lot of people panic in a COVID kind of situation, and when markets have been running away, they will come and heavily allocate to equity in a sectoral fund which is peaking out, or do crazy things. So not falling prey to emotions is the thing.
Right. And before I let you go, Rajiv, what do you do to, de-stress yourself? Do you travel? Do you like to travel? Do you like to, I know you like to read, but apart from that, how do you, what are your hobbies? How do you keep yourself fit?
So travel is one long vacation a year and a lot of short trips whenever there are long weekends. So that of course is there. Otherwise, the usual suspects: music, OTT content,
Okay.
playing chess online. So
And how do you, physically, do you follow any routine or 10,000 steps?
yeah, so it's something that is aspirational, but I'm not there. So I continuously struggle with my fitness goals.
Thanks, Rajiv, for joining us today and sharing all those insights.
Thank you for the opportunity.
That was all the time we had for today's episode. For more such interesting content, keep watching Mint.